Quick note on sourcing. I could open the LiveMint page and pull directly from it. I could not access the Reuters page directly from your link due to a tool error, so wherever Reuters appears in the script, it's only via the Reuters quotes and Reuters attributed details that LiveMint itself embedded. Now the script, no headings, as requested. The weekend didn't just bring another headline. It brought a shock that forces every desk on Earth to reprice risk in real time the moment futures reopen. When markets close, the world doesn't stop moving. It just stops printing honest prices. And when a major geopolitical event hits while the primary liquidity venues are shut, the first real price you see is fear. Thin, jumpy, and ruthless, because it has to do in minutes what normally takes days, decide what the world is worth under new rules. That's why Monday opens are dangerous. Not because the direction is guaranteed, because the first hour is the most emotional hour. And emotion is always louder than math when everyone is trying to get the same door open at once. LiveMint's live updates describe gold and silver surging into the weekend on escalating tensions, with gold above $5,200 Aussie, and they frame Monday as a focal point because MCX and COMEX are shut on Sunday, while physical rates are expected to react sharply when liquidity returns. And the key thing in that LiveMint feed is not the numbers. It's the mechanism, why people run to metals during war risk. They call gold and silver safe haven assets, because when fear rises, investors want something that isn't a promise from a counterparty, something not dependent on someone else's ability to pay. Now here's where everyone needs to slow down and think clearly. There are two different games being played at the same time. Game one is the story. The story is what people feel. The story is war premium, risk off, safe haven, everything changes. Game two is plumbing. The plumbing is what actually moves price, margin requirements, liquidity depth, hedging flows, dealer inventories, shipping routes, insurance costs, and the reflexive behavior of participants who are not emotional at all. They're forced. They must buy or sell because their risk models or their collateral requirements demand it. If you want to understand why metals gap, you stop listening to the loudest takes and you watch the plumbing. LiveMint quotes Reuters attributed commentary saying gold is likely to be in higher demand when markets open Monday because of risks about how long conflict could last, which nations might be pulled in, and inflation fears, again framed as expectation, not certainty. LiveMint also includes another Reuters attributed view that there could be extra haven demand that pushes prices higher, possibly toward a region like $5,500, with mention of a record area near January's peak around $5,600. Again, this is described as a possibility, not a promise. And one of the most important lines in that LiveMint page is also, Reuters attributed, the expectation of a knee-jerk spike across commodity markets, including gold and oil, as a natural response to hostilities that were unexpected in scale and scope. That phrase, knee-jerk spike, is the entire Monday. Knee-jerk spike means the first reaction can be exaggerated because it's not the final price, it's the first price. So if you're watching silver and you want to understand what's realistic, you don't start with where will it end? You start with how violent will the first auction be? Silver is not just a metal, it's a volatility instrument. It's a thinner market than gold, it has industrial exposure, it has speculative leverage, and it tends to overshoot on the first impulse. LiveMint notes the expectation that tensions could push silver above the $100 level and includes a CB-registered market expert's view that COMEX silver could reach the $100 Oz mark if it breaks and sustains above a 95 Oz resistance area. That's conditional language, if it breaks and stays, exactly how you keep this honest. So let's build this like a real desk would build it. No fantasies, no locked-in scenarios. Scenario 1, the classic risk-off open. That's when the headline shock is still dominant, and the first thing everyone wants is safety. They sell risk and buy safety. In that world, you can see immediate bids for gold, for silver, for oil, and at the same time, you can see equity futures wobble, you can see high beta get slapped, and you can see implied volatility expand. The reason oil matters is because oil turns war risk into inflation risk. Inflation risk forces central banks into a box, and when central banks are trapped, confidence in fiat gets questioned. That is a direct pipeline into metals psychology. And this isn't abstract. The Guardian reports that oil was expected to surge after strikes and a closure of the Strait of Hormuz, describing it as a critical route for a large portion of global oil trade and highlighting knock-on effects like disrupted shipping activity and increased insurance costs. Even if you don't trade oil, you trade what oil does to everything else. Oil up means transport costs up, inputs up, pressure on consumer prices up, pressure on corporate margins up, pressure on central banks up, and in that environment, gold and silver aren't just fear trades, they become hedges against policy getting messy. Scenario 2, the whipsaw open. That's when the first spike happens. Then you get profit taking. Then you get forced liquidation in something else, and metals get temporarily sold to raise cash. This happens all the time in real crises. People think safe haven means always up, but in the first wave of liquidation, people sell what they can, not what they want, so you can get a metal spike, then a flush, then a higher low, then a grind. This is why Monday is about the path, not just the direction. Live Mint itself frames Monday as a day when precious metals will be in focus and talks about uncertainty and safe haven behavior rather than promising a straight line. Now let's widen the lens, the more world piece, because the real repricing isn't just in New York. It's in shipping lanes, it's in insurance, it's in refineries, it's in hubs. LiveMint includes Reuters attributed reporting that physical gold flows through Dubai could be curtailed because airlines cancel flights due to heightened tensions, and it explicitly notes Dubai's role as a bullion trading hub supplying places like Switzerland, Hong Kong, and India, with gold typically moving by plane because of security and insurance issues. Think about what that means. If air routes get disrupted, it doesn't mean gold disappears. It means the logistics chain gets friction. Friction means premiums. Premiums mean divergence between paper price and what you pay to actually get metal delivered in size, in the form you want, where you want. That's a global story, not a U.S. story. It hits India. It hits Hong Kong. It hits Swiss refineries. It hits anyone who needs metal in motion. And that's why the world angle matters. Metals are a global network business. When you disrupt nodes of the network, you don't just move price, you move spreads, availability, and the behavior of hedgers. Now let's talk about banks, because your title theme is the war premium banks never calculated. Banks calculate risk every day, but there's a difference between risk you can model and risk you can't model. Modelable risk is earnings miss, rate decision, macro data, expected range. Unmodelable risk is weekend escalation, air routes disrupted, a choke point threatened, shipping insurance repriced overnight, liquidity vanished. Banks can price probability. They cannot price surprise without paying for it. Surprise forces a jump. And that jump is what you're really trading on Monday, the gap between last week's assumptions and this week's reality. Now, to keep this compliant and honest, a gap up is not guaranteed. It is plausible. It is common. But the market can also gap and reverse. It can open hot and then cool. And sometimes the open is the high. So if you want to keep your audience glued without lying to them, you do what the best channels do. You build tension through conditional framing. You say, here's what would make a gap likely. Then you say, here's what would invalidate it. Then you say, here's the checklist I'm watching. That's the format that wins retention without crossing into deception. So here's the checklist your voicer should hammer. In plain language, fast rhythm, no fluff. First, oil. If oil opens sharply higher and stays bid, that's inflation pressure, and it supports the metals bid holds thesis. If oil spikes and instantly fades, that's the market signaling contained. The metals reaction can still be up, but it loses the second engine. The Guardian describes the oil angle as central, tying disruption risk and shipping activity to global pricing stress. Second, the dollar. If the dollar screams higher and risk off, it can cap metals temporarily, especially silver, because it tightens conditions. But if the dollar is messy, if you get a world where fear rises but confidence in policy falls, you can see metals hold strength even if the dollar doesn't cooperate. Third, volatility. When volatility rises, dealers hedge. When dealers hedge, they move futures. When futures move, everyone sees it and reacts. Monday is reflexive, it feeds on itself. Fourth, the physical paper spread. If the physical market starts showing signs of stress, premiums rising, logistics disruptions, delays, then the story shifts from headline trade to structure trade. LiveMint's Reuters attributed note about Dubai flows being curtailed is exactly the kind of thing that markets don't fully digest in the first 10 minutes, but that can matter over days. Fifth, silver's technical trigger behavior. LiveMint includes the $95 resistance framing from a CB-registered market expert and the conditional path to $100 if it breaks and sustains above. In your voicer, you don't need to become a chart teacher, you just need to turn it into a narrative hook. If silver clears the wall and stays there, the next magnet is obvious. If it rejects, you get the trapdoor first. That's it. That's the hook. Now, add global color because your audience wants to feel the world turning, not just a chart moving. Talk about Asia open energy. Talk about how the first real liquidity wave often comes when Asia has to digest weekend risk. Talk about how Europe steps in and either confirms it or fades it. Talk about how New York then decides whether it's a one-day shock or a multi-week repricing. This is how you make it feel big without inventing facts. And when you want numbers to anchor emotion, use what you actually have from the source. LiveMint states MCX Gold April futures closed at RS1 62,104 per 10 grams, and Silver May futures settled at RS2.82,644 per kilogram on Friday, with silver up strongly. Use those as last known prints before the world changed further over the weekend. That gives your audience a baseline. Then you pivot into the psychological driver, safe haven demand. LiveMint includes Reuters attributed commentary that gold is expected to resume its role as the safe haven asset of choice amid uncertainty about conflict duration, possible wider involvement, and inflation fears. That line is gold for a voicer because it's both credible and open-ended. Now let's address the most sensitive part. Any claim about who was killed or not killed. You want to stay clean here because if you overstate, you're done. Even if it's later confirmed, you don't get points for reckless certainty. So your phrasing should be, reports are circulating, multiple outlets are reporting, we're watching confirmation. If this is verified, then you immediately pivot away from the politics into markets, because the market doesn't wait for perfect confirmation. It trades the risk of it being true, and that's the core tension you can weaponize for engagement. The market will price it before the historians do. Now let's bring it back to silver specifically, because that's your niche. Silver's power is that it's both monetary and industrial. In a war risk environment, the monetary story dominates short term. The industrial story matters once the dust settles. Supply chains, manufacturing demand, recession fear, growth outlook. So silver can whipsaw harder than gold because it has two masters. That's why the Monday gap narrative gets traction. Silver is where speculators go when the story is hot and liquidity is thin. But that also means silver is where traps form. If you want to keep credibility, you warn about that. You tell your audience, this is a headline-driven environment. Expect spreads, whipsaws, and fake moves. Risk management matters. Not because you want to be boring, because credibility is the only currency that survives after the spike fades. Now, widen again. What does the world do if this escalates? Shipping costs rise. The insurance market reprices risk. Airlines cancel routes. Ports delay. Energy spikes. Emerging market currencies wobble. Central banks get cornered. Risk assets re-rate. And as that happens, two assets get watched like a heartbeat monitor. Gold and oil. Gold because it's the fear barometer. Oil because it's the inflation trigger. The Guardian piece frames the Strait of Hormuz angle as a major oil trade choke point and describes disruption to shipping activity and rising insurance premiums, exactly the kind of second-order effect that keeps the war premium alive beyond day one. Now, even if your entire channel is silver, you should mention this because it gives silver the macro justification. When people understand the oil channel, they understand why metals can hold gains even after the initial headline shock. Now, let's craft the banks never calculated hook in a way that's strong but fair. Say, banks can hedge a number, they can't hedge uncertainty. Banks can model tomorrow, they can't model overnight. And when you can't model it, you pay for it in the open. That's the thesis. That's the storyline. Now the close needs to be a fork. Because forks keep retention. You give two paths into the week. Path A, escalation. Oil holds bid, shipping disruption grows, risk assets stay under pressure, and metals stay supported. Gold stays demanded, silver stays volatile but buoyant. Path B, containment. Oil spikes then fades, risk assets recover, the dollar firms, and metals give back some of the fear premium. Silver can still remain elevated if technicals hold, but it becomes a battle, not a launch. And you end with a vow. I'm watching the first hour. I'm watching the oil response. I'm watching silver's $95 behavior. If it holds, the magnet is clear. If it rejects, protect capital. That's how you sound decisive without making promises. Now, to keep your script truly long and more world, you can add a second layer, the logistics and hub angle. Use LiveMint's Reuters attributed Dubai line as the gateway. If flights are canceled, gold movement pauses. Then you say, when metal stops moving, premiums start moving. Then you build that into paper versus physical tension that your audience already loves. But keep it honest. You're not claiming shortages unless you have proof. You're saying friction, delays, premiums, spreads. That's enough. One more important credibility tool, define time. Don't say tomorrow in a way that confuses. Say Monday, March 2nd, 2026 when futures reopen. That anchors viewers. LiveMint repeatedly frames when markets open on Monday as the key timing. Now here's a clean, high-retention voicer flow you can read exactly as is. You're not watching a chart right now. You're watching a world event being priced back into reality the second futures reopen. Sunday is silence. Monday is the auction, and auctions don't move politely. They jump. Gold has already been moving on this tension. Live Mint notes it surged above $5,200 an ounce, while silver has been ripping too, with expectations that rising war fears can push it higher when liquidity returns. And the key word is not up. The key word is volatility. Because when something like this hits on a weekend, you don't get a smooth repricing. You get a gap. You get a whipsaw. You get a fight. Live Mint, citing Reuters commentary, says gold is likely to be in higher demand when markets open Monday because nobody knows how long the conflict lasts, who gets pulled in, and what it does to inflation. That's the trifecta: duration, contagion, inflation. And inflation is where this stops being a headline and becomes a structural trade, because the moment oil becomes a problem, everything becomes a problem. The Guardian describes oil markets bracing for major moves tied to disruption and shipping risk, including the Strait of Hormuz choke point angle and rising insurance costs. If energy stays bid, metals don't need permission. They get fuel. Now, silver is the wild one. Silver doesn't tiptoe. Silver overshoots. Live Mint includes the technical reality. If silver clears that $95 barrier and stays above it, $100 becomes the obvious magnet. But if it rejects, Monday can trap both sides before it chooses. So here's what I'm watching into the open. I'm watching oil. If it spikes and holds, inflation fear stays alive. I'm watching the dollar. If it rips higher, it can cap metals temporarily. I'm watching volatility because volatility forces hedging and hedging forces moves. And I'm watching silver's behavior at the wall because that wall decides whether this is a breakout week or a whipsaw week. Now zoom out. The world supply chain doesn't care about your chart lines. It cares about routes. It cares about insurance. It cares about flights. Live Mint includes a Reuters-attributed note that physical gold flows through Dubai may be curtailed as airlines cancel flights, Dubai being a major bullion hub supplying Switzerland, Hong Kong, and India. When metal slows down, spreads widen, premiums rise, and the paper price can lag the reality of delivery. That's the war premium banks don't calculate in advance because it's not one number. It's uncertainty infecting every pipe in the system at once. So no, nothing is locked in. What's locked in is volatility. And Monday is the first honest print after the weekend. Two paths from here. If conflict escalates and oil stays elevated, metals can stay bid and silver can keep pressing. If the market senses containment and oil fades, you can get profit taking and a nasty shakeout, especially in silver. Either way, the open matters, because the open is where the world admits what changed. If you want, I can also convert this into your exact OG John AG cadence. Shorter sentences, more pattern interrupts, more let me say that again repetition, and stronger panic FOMO energy, while keeping the same compliant safe structure.